in a service. We are truly in a service-based profession, and we take great pride in that and commit ourselves tirelessly to the health and well-being of others. Our roles as healthcare professionals transcends really being just a job. It's really a vocation and a calling and a devoted effort to enhance the quality of life for everyone we serve. Because if you don't have your health, you don't have much. So, amidst our rigorous schedules and the emotional toll of working in healthcare that it sometimes takes, it's really important to keep one aspect in mind, and that's self-care and safeguarding our financial well-being, both for not only our families, but future generations of our families as well. This is just a brief info about me. I am in the physical therapy field. I've been an orthopedic physical therapist for over 20 years. Certainly, my goal, like all of you, is to transition full-time into real estate. It's happened a couple of times very close, but we haven't necessarily got there yet. But again, we keep trying every day and get 1% better every day. And hopefully that will happen, obviously, real soon. I do enjoy serving people in the healthcare arena, just like I like serving people in the real estate arena. My wife has been a financial advisor for 25 years, so you can imagine some of the spirited discussions we have about building wealth. It's actually really enlightening and always good for open and healthy debate. I have 2 kids. I love coaching their sports teams. Anyone who knows me knows I'm probably, if I can't make a real estate event or a webinar, I am probably coaching a child in sports. So, and I love to cook. So, hopefully someday you'll see me with a chef's hat on making these funny reels and videos that are not only educational, but entertaining in nature.
So Alex Tam here, and for me, I've had my own chiropractic integrated medical practice for the last 15 years now, and stumbled into real estate when I went to a Grant Cardone conference. And from there, it's just been investing, that was since 2018. So it's been 7th year now investing in real estate. I'm looking into really growing the practice and real estate at the same time on top of the virtual assistant agency. With me, Helen is, my wife, she's really like the one that allows me to do everything that I do outside of the house. Like just yesterday, she was cooking from 10 a.m. to about 6 p.m. because to celebrate Chinese New Year. And
I'm
my
coming
family was
over.
over. I'm telling you, I said, "Oh my God, this was like Thanksgiving."
Holy cow, that is
And
fantastic.
you know, and she's like, "No, no, we should do this. We should host this." And then sometimes towards the end, she's like, "Oh my God, maybe we should have went to a restaurant." I said, "Yeah, you cooked all day, you know." And today we're heading out to my mom's and my aunt's place, and but real estate has really allowed us to be able to do these things. So we're really looking forward to today as well. Now, in our profession, the balancing the patient care with business aspects of our clinics demands is not just medical expertise, but also a strong grasp on financial management to ensure sustainability and growth. As we're delving into real estate investments, an area right with potential yet often overlooked is the strategies to reduce property taxes, expenses, how to leverage reduction of, getting more profits, overall. So really, when you look at this, the medical approach is the prevention over cure, aims at proactively managing overheads to secure a more profitable, sustainable future for our practices and ourselves, and looking at how do we do that for real estate as well. So we're going to dive into how to pay less taxes, right? In all, especially what Eric said is like, hey, April 15th is coming up. It's around the corner. Everyone's getting their cost seg studies in, right? And we'll talk about how that was how I really fell in love with real estate was this taxes play, and it was by mistake. And I'll share my story with you guys later on.
So general ways to pay less in taxes when you're owning multifamily real estate. And these are just general categories just to think about if you have not already done so. Most people who own multifamily real estate or real estate in general have probably done one or all 3 of these steps. But number 1 is find great professionals that can assist you in your journey. And what we mean by great professionals are accountants, attorneys, real estate attorneys, obviously tax attorneys, which, specialize in corporate taxation. Any professionals that can assist you on your real estate and tax savings journey is you have to have a team, right? You have to have, just like in multifamily, where you have a great operational team, you have to have your operational team working for you to make sure that you are maximizing all tax benefits. Number two is forming a business entity. Which is an LLC or an S corp to maximize tax advantages. This is so important. I don't know anyone in my inner circle that owns real estate in their own name. And there's a reason for that. Not only legal, but tax liabilities. So forming an LLC or an S corp can really shelter your real estate investments, specifically your multifamily real estate investments, from both tax and legality issues. And then certainly number three, we've all heard this, or at least some of us have achieved this, is to achieve real estate professional status. And there's very specific rules about achieving real estate professional status. But three of the main ones are you have to perform more than 50% of the services in a real estate trade or business. And a trade is defined as the development, renovation, or any such real estate related activity. Number two is you have to perform 750 hours of service in real estate related business to be considered for a real estate professional status. And number three, which is, again, it is clearly defined according to the IRS, is you have to materially participate in your real estate activities, whether that's your rental properties, you're buying multifamily real estate. All of these things are clearly defined on the IRS's website, and they are very particular about you documenting your hours because they don't obviously want anyone to be achieving real estate professional status if you are not obviously materially participating in that in terms of the number of hours and the activities that you do. So again, number three is a little bit more detailed because there's more rules and restrictions, but we just wanted you to be aware that that is also a huge tax savings if you can achieve that.
Now, how many people right now is not investing as an LLC or an S corp? Any show of hands? Anyone who's not, or is everybody doing that? All right.
Okay, that's good.
Okay.
That's good.
Okay.
Well, I have to say, I'm probably the only one because I didn't know any better when I started. So I have 3 property under my name, but I'm switching to the LLC right now. I'm talking to the lawyer.
We gotta
Yeah, that's
that.
good, Smitty. Yeah, right. I mean, and everybody starts off at a different spot. So if you don't know to do that, then you're not gonna. I mean, you don't have that education, but now you do. So yeah, that's.
However, if you already put in under your name, you need to check with the bank because when you transfer to LLC, that's actually an event that could trigger due on clause. So just want to check with the bank, and I already checked with my bank last week, and they say it's okay to do it. So,
oh, good.
Awesome.
That's a good tip, Smitty. Thank you.
Yeah, awesome.
So y'all don't mind. Well, can I ask a question real quick? Am I on mute?
You're kind of sounding a little mumbled. Yeah.
1 second. Is that better at all?
Yes.
Hey, so I do invest under my LLC, but whenever I bought my single family home about 2 years ago, I bought it under my name and I just recently switched it over to my LLC. But regardless if I did that or not, they said the taxes are filed the same. So
when it's your own home.
Yeah, okay. But it was a rental home though. So even if even if it was an LLC, they're filing it the same. So is there still that tax benefit?
Well, part of that is when you are, from my understanding, is if it's a rental home, part of having an LLC is you're now forming a business. Even though it's taxed the same, that it flows through the same, you can now have business deductions. Whereas if it was in your name, you wouldn't be able to have that. Right.
Well, Alex, can I say one thing also?
Yeah, go for it.
So, guys, I mean, besides the tax benefits, I'm correct me if I'm wrong, Alex. You need it in an LLC because for protection. What if you get sued?
Yeah,
I mean,
that's the next thing.
Yes.
Amika, forget about the tax savings. If you guys are buying single family or multifamily and you don't have an LLC on, say it's multifamily, you don't have an LLC with the partners, and then you don't need an LLC. The property on the multifamily needs an LLC, and then you could sign on your name. That's fine. The single family you buy, it's got to be somewhere. You guys have to have an LLC somewhere, or else if somebody's, my accountant goes like this: if a kid's riding a bike through your yard, he falls and breaks his leg, the parents sue you. And my daughter goes, but why? He's trespassing. Doesn't matter. Even if you have a sign on, don't trespass. It's like the McDonald's story. The lady spilled hot coffee on her leg. Now McDonald's has to put on the cups, contents are hot. She won $1 million. So if you, Amika, if you don't have an LLC on that single family and somebody breaks your leg in the yard, they're suing you personally. You understand? Am I wrong? Am I wrong or
No,
right?
you're
Alex?
right. It's the protection.
Agreed,
And on top
yeah.
of that, the tax
Yep.
savings, and you're running it as a business.
Yeah.
Now,
So-
so let's
However,
say,
oh, go ahead, Amika. I was gonna say something, but go ahead.
okay, I was gonna say, so like I said, it just got transferred. The deed got transferred to my LLC from my name. So the day that happens, I'm immediately protected. There's no way to go back just because it was used to be in my name.
You can
Unless
go
if
back
they-
back
unless
and
if they
forth.
fell when they were in your name.
Okay. So it just matters when the incident, if it were to happen, it just matters who the property's name is under when the incident happens.
From my understanding.
Yes. So this is why, guys, in MIH Mastermind every month, people want to rush and buy properties, single family, multifamily, everything. And that's why we had the trust call I had, because like I explained it to my daughter, she could not understand it. And my accountant, who's great, gives me scenarios. What if this guy dies? And what if that guy gets hurt? What if this guy gets cut? We love the tax benefits, but there's always more than just the tax benefits is in protection. I'll give you an example. I have you got to ask about umbrella policies. When you don't make a lot of money, you don't need it. But I have an umbrella policy on my house, because if
Same.
something happens, if something happens, I don't know if I have 5 million, 1 million, 10 million. I don't know what I got, but I got my accountant and my finance guy. We looked at my stuff, and I had to get an umbrella policy because the better you do, the more protection you need on top of
Oh,
this stuff. So that's
100%.
the only thing you have to be careful.
Yep. And they are very inexpensive, guys. I think less than like 1,000 a year, But I just want to bring one thing up. So one only small hassle, if you have under LLC, and let's say you own 100%, let's say between 1 through 4 units, considered as a residential multifamily. If you want to refinance that in the future, the lender is going to ask you to switch it back to your name first before you can refinance. And after you refinance, you can switch it back again to an LLC. So for some reason, you
Smitty,
cannot
I don't-
refinance.
I don't know what you're talking about, because I refinanced all my properties and I never had to do that.
No, I'm talking about the small multifamily, like between 1 to 4, and they have residential lenders, not like commercial lenders.
Oh, okay. It's weird because I had a 4-unit and we had an LLC on the property, not in my name.
Oh,
I'm trying to think.
really?
Yeah, so I mean,
Okay.
yeah, but if you have a 4-unit and the property has an LLC, you don't need an LLC. You understand?
So you can refinance with LLC intact. You don't have to switch the deed. You don't do quit claim deed back to your name before you do refinance.
Well, I don't know. To understand it, me and my brother bought this 4-family, right? When I was 23. We had an LLC Margab on the property, and it was me and my brother under the property. We didn't get another LLC. The property had an LLC, and we refinanced twice. We never had an issue.
Okay.
That's
Maybe
good
I
to
need to get
know.
a new lender, but thank you for
No,
telling me that.
I had it.
Thanks,
They
guys.
made me because it was under my LLC.
We
and when
gotta continue so that we can stick with the
No,
time, everyone.
continue,
Chat it up
sorry.
afterwards, guys. All right, go ahead, Eric.
So specific ways to pay less taxes through owning multifamily. And this is just a summary. I'm sure that we're probably excluding some things on this slide, but we just wanted to hit on the major points. Cost segregation studies, depreciation, bonus depreciation, property expenses, mortgage interest deductions, pass-through deductions, 1031 exchanges, which occurs when you obviously sell a multifamily property, capital improvements, and passive losses. So cost segregation, and I know Alex obviously alluded to this a little earlier, come tax time, a lot of people are getting cost segregation studies done. And what a cost segregation study is and I think everybody's probably pretty aware of it on this call, but it's good to review. It's used to examine the components of a multifamily building and determine which components are eligible for accelerated depreciation. We thought when we were doing our research for this presentation, Alex and I really thought that this slide really hit home to describe it what we're talking about. This is an increased deductions with a cost segregation study versus without a cost segregation study for a particular apartment building for the first 5 years. You can see with the study, with the cost segregation study, after year 5, the total deductions that you're taking, which is in the middle of the chart on that last column, it is $1.4 million. And without the study, the total deductions were $729,495. That is almost a 50% gain in savings with a cost segregation study versus without. So right there, to me, that tells you that whatever that cost segregation study costs, it is well worth the money that you're paying. Because if you can save almost 50% or have 50% in accelerated depreciation, that's worth it to us.
Now, depreciation is huge because depreciation potentially reduces the owner's tax liability, leading to significant costs and tax savings over time. This acts as an incentive for investing in multifamily properties by providing a mechanism to recover a portion of the initial investment that was done. And that depreciation not only goes against the income from the property, but that is partially what that cost segregation study is an accelerated depreciation. And that's where the bonus depreciation comes in. Now, we all have heard that it is a step down from 100 to 80, 60, 40, 20, and 0 as of 2027. But there's a big but, and some of you might have known this, and some of you might not, right? On January 31st, on Wednesday, this bill got passed, which extends it back to 100% bonus depreciation. Okay. Now, you guys might want to check on this because just like the disclaimer from the get-go, these are information that we found on the internet. Make sure you check with your accountants and CPA, but this went through and we are super, super excited about that. This bill extends 100% bonus depreciation from January 1st, 2023 through December 31st, 2025, right? Now, what happens after 2025? We don't really know yet, but at least from 2023 all the way to 2025, 3 years, we're covered for now. And that's what I am excited about, right? So check out the links below. That's where the source came from. So we're super excited about that. Now, Eric, for property expenses, I mean, overall, when we look at these, it's expenses that can be deducted from your rental income, which can be reduced, taxable income. Examples of these include property management fees, repairs made to the property, maintenance issues, utilities, insurance costs. This is one of the main reasons to have that LLC or run the property as a business, because there are these fees that could be deducted. And there's also business, fees. Like, for example, if you did this as a business and you went out and had dinners and whatnot with people, that can be, counted as a business expense. That could be done as well if you own it yourself. Of course, it could be a little murky if you're doing it with partners that way. But there's a lot of expenses that could be deducted, and it's non-taxable events. So make sure you guys understand that as well.
And, there's also mortgage interest deduction too. Some people are aware of this in a multifamily property, some aren't. And most people get, mortgage interest deductions on their single families or their primary residence. But if you have conventional financing through a mortgage, then the interest is a potential deductible expense against your taxable income. Certainly your CPA, if they are familiar in any kind of commercial real estate, or real estate in general, should know that is one of the common things that can be deducted.
There's a pass-through deduction. This is the Tax Cut and Jobs Act that we really talked about earlier, right? Where these allows the pass-through entities such as an LLC, certain partnerships, S corps to deduct upwards of 20% of qualified business income from their taxable income. And I want to make sure everyone's aware of this as well, is that certain professions don't have this. Like for me, having a medical practice, this doesn't qualify. Certain accountants doesn't qualify. Attorney businesses doesn't qualify as well. So talk to your accountant before you take these deductions.
And 1031 exchanges. And I think most of us on this call know what a 1031 exchange is. Basically, in summary, it allows a deferral of your capital gains taxes from the sale of a property by reinvesting the proceeds into another property. Now, there's certainly some rules that are associated with this, some very specific rules. And if any, you have to identify the property that you're exchanging or going into 45 days. You have 45 days to identify the new property. You do have 180 days from the close, when you sell your first property, to identify the sale of a new property. So I know we've heard sometimes 90 days identifying a new property, but in terms of the research we've done, we found that it was 45 days to identify a new property. So if there's been any rule changes on that, please let me know so that we're obviously providing accurate info to people. But I believe it's 45 days to identify a new property and 180 days to close on the sale of a new property from the time that you closed on your first property. So if you closed on your first property on January 1st, 2024, 6 months later is July 1st, 2024, though that is the parameter that you have to complete the 1031 exchange. And also it's very important that second property that you're exchanging into has to be of equal or greater value than the one that you just sold. So there's other rules that are certainly applicable, but those are the three main things that we want to impress upon people when doing a 1031 exchange. And Alex and I have talked about this in great detail before. There are specific attorneys and specific accountants that specialize in just 1031 exchanges as well. So it's a very interesting concept to learn, to be educated about, but it's also, there's some layers of rules there. We just gave you the basics right off the bat.
Now, capital improvements and passive losses, right? Expenses from renovations, enhancements to a property may be eligible for depreciation or could be treated as a deductible expense. And then there's passive losses. If your expenses in a multifamily property are greater than your rental income, then you may be able to offset those losses against your taxable income as well. This is on top of the depreciation that you are getting. So in our commitment, ultimately, Eric and I are doing this to really educate others in the real estate community, in the healthcare community as well. And for those of you who are watching it live, thank you for showing up. For those of you who are watching this as a recording, reach out to Eric and I, as every single month we'll be going over different topics, right? And on the next one is, well, how do you qualify? How do you qualify to become a real estate investor? We'll talk about the difference between a 506B, a 506C, maybe some of the different ones and qualifications that are out there. And you guys can reach out to us. We're not that hard to find, right? So reach out to us anytime. And then I'd like to take this time now to really dive into the questionnaires that are in the chat itself. One of the first questions that are on here, I see that Seep was saying that he has a 4-unit where it's under his own name, so that might be something to really work on, Seep.
Who has it? Who has it under their own name?
I do, Marco Sip.
Okay, Sip. Let me ask you. I'll get you to answer the question by asking you questions. Why didn't you? Like I said, me and my brother bought the that four family. We formed an LLC. My accountant told me to, like Margab, and then just one LLC for the property. Why didn't you form an LLC?
Because I was under the impression, just like Smitty, that if I formed an LLC, I could potentially trigger the due on clause sale. I mean,
What's the due on clause sale? I don't even know. I mean, I should know. What's the due on
Yeah,
clause?
it's when the bank wants you to pay off the mortgage because the property was transferred over to
All at
Never-
once.
all at once.
Well, no, you should. What I'm saying, when you bought it, you put the LLC there.
Yeah, well, I wasn't as educated when I bought it, so
Oh, okay,
that's
no,
part of it.
that's it. There, you answered it. So
Yep.
technically, for whoever's on this call, if you go buy a four family, you put you just get an LLC, because the simple, to keep it simple, stupid kiss. If somebody sues that property, they're suing my LLC Margab, not me personally. Okay, I don't know. You got to educate yourself. I've never had to do it because I always had the LLCs in the proper place. I think you could do it now. I would ask your accountant or somebody who knows real estate really well, like what's it going to trigger. I've never had to do it, so I'm not going to say I know about it. But you kind of want to. I'm thinking you kind of want to have an LLC on that property. You don't want to get sued personally.
Hey, Cipriano, quick thing. If you will trigger due on sale clause, you can quick claim the property back to you and show it to the lender. So it's super easy. Quick claim deed is, I don't know, a few $100. So quick claim deed.
I learned something today. I didn't know.
Yeah, quick claim deed it back to you, show it. And also, if the lender asks and goes, what happened with the property, just say, hey, listen, I'm so busy, I have a third party paying my loan for me.
Vlad,
it's
I have a
here
question
and
for you. Where should he form this LLC? Does it matter? Does it matter Wyoming?
it doesn't matter.
It doesn't matter, right?
I do Wyoming.
Yeah,
Yeah,
so
I mean that's
and then
what
he can use that
initially.
he can reuse that for other properties, correct? Or no?
You can technically. What I do is, since it costs some money to start off an LLC, I just change it. Like, for example, I had a property in Cherry Hill. It was 419 Gatewood Road LLC. I sold the property and I changed the name to Zantic One, and now it's my investment LLC. So I just changed the name. It was like $80, and that's it.
Yeah,
I don't want to
have a
open
couple
up a new one.
LLCs. I have one that I was going to dissolve in York or something. My accountant's like, dude, it doesn't cost anything. He's like, do you think you might buy something there? And I'm like, yeah, I might actually. He said that. He goes, then keep it and just change the name when you need it. Because to start it up again, I would spend the 200, 400, 600, depending on what state. And he's like, dude, I'm probably going to buy something there. So he's like, just keep it and just transfer the name.
Yeah.
Okay. Hey,
Now,
Vlad. I'm sorry, Alex, to interrupt. Vlad, can you recommend anybody who's reputable in our area? I know you're in New Jersey. I'm in Pennsylvania. If you can recommend somebody, that would be awesome, because I'm having trouble finding a good CPA who's well versed in real estate. And
Sip, I got somebody, Sip, and it's going to be Joseph will be able to help you with LLC and CPA. Starting April 1st, I'm going to be referring. I'll have real estate accountants for the mastermind, because I've gotten 100 people who asked me for a good real. I can't give them mine. I have 3 real estate accountants. 3. I got 45 K1s, and I had one. I grew so much that I need 3. I'm not a big corp. They're literally splitting the 45 K1s, so I can't give people my accountants, because then they'll fall behind on my work. But we interviewed and we found accountants for the MIH mastermind.
Awesome.
Okay.
Thank you.
And
Thanks,
for
Vlad.
the protection, Michael Sanchez. Michael's the one that told Helen and I a couple years ago about Anderson and Associates out of Las Vegas, and that's where we formed the LLC, the holding companies in Wyoming. And the cool thing is that the Wyoming and Delaware and Texas, I think, started it this year as well, or they were in the process of, are the only states where you can look up the LLC and you can't see who the managing partners are, where every other state will expose that and they can come after you. So if you were to put an LLC in the property, because then the property may need to have an LLC in that state, but the managing partner is a Wyoming LLC. When someone tries to dig into that Wyoming LLC, they can't find out who actually owns that. And if they can't find out who actually owns it, then they won't find out that you also own this property, have this investment, have da 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 da. And that's really something that's going to be huge in terms of protection. Now, as I look at the chat here, let's see, Vlad mentioned something about the LLCs. Smitty says, how does the LLC is able to get a loan with no track record? Anyone can answer to that?
Yeah, so the LLCs, like as long as you're willing to be open with the bank, right? Like you don't have to have, like Alex is talking about, we put a lot of layers in place. So if somebody else came and looked for us, they wouldn't be able to find us. But for our loans, every time we buy a property, we're starting a new LLC. And that's a question that a bunch of people asked us, was the track record. But what we do is we show them that, hey, we are the managing partners or the owners of this. This is our track record as a whole, or the way you have your tiers set up, right? Like we have our holding company, which owns all of our properties underneath. Our holding company as a whole has experience. It's one of those things more that you just have to show them and sell them and lead them in the right direction at the bank. Don't let them make assumptions. And if you talk to the first person that's giving you this advice about, oh, I don't think we could do this, try to go around them to somebody higher up. That's usually the front line, and they're just saying no because they don't know. But anybody that's really in real estate lending, they will have seen this a million times. Like my title company, our lenders, everybody, they have like, 12 companies from us on file because they know the weird structure that Anderson has set up, but it's a new one every single time. But our track record is still able to promote that. My wife and I's track record overall, right? But it's just more protection from the outside world. But the lenders, they have all of our stuff. Yeah, and if a lender's really not doing it, then absolutely find another lender because there's many out there that'll do it.
Yeah, awesome. Thank you, Michael. And Emeka asked the question, how does bonus depreciation work? So ultimately, that's where the cost segregation that we talked about came in, is when you do a cost segregation study on a property, instead of doing it over 27.5 years, you're able to accelerate a majority of that into year 1 to 5. And that's how you would get the bonus depreciation. And then the losses that you get from that, if you are a real estate professional, can work against your income as well. And that's how, that's how, I remember at the beginning of the call, we talked about, I wanted to share my story. That's how I really got into it. Was a few years ago, my CPA, when we started really investing into real estate, one of the 1040s that we got, we're about to file taxes. And, I'm paying all my quarterly taxes like I usually do. And that one year, he came back and says, dude, Alex, you overpaid 87 grand in taxes, man. And I was like, holy crap. I was like, how did we do that? I said, did I screw up or did you screw up? I want to know what happened. What happened? I'm not pointing any fingers. I just want to know what happened. And he's like, well, you started really diving into the real estate world and you got a bunch of K1s, right? Your wife has rep status. So now it offsets against your active income because you guys are married. And I was like blown away. And he says, what would you like to do? Save it for next year or bring it back? I said, it'll probably take him forever to give it back to me. Save it for next year. So I don't have to pay him as much the following year. And that really opened my mind. And what I have done is, being in California at the time, we were doing like 45, 48, whatever percent taxes it was crazy. So my goal was to lower our tax bracket year after year after year as we invest in real estate. And I believe last year we were in the 20 percentile, and it was amazing, right? And I tell other doctors and other friends that who don't realize this. I mean, the tax savings by itself. Imagine if you invested $100,000, this is just numbers here, right? 100,000, and you're able to offset, say, 60,000, all right, on the low end of that in depreciation. That's very fair, okay? And at 60,000, at 40%, you're talking about $24,000. So when people are like, oh, what's my cash on cash? What's my IRR, ARR? I was like, yeah, I love those numbers. But in year one, I can capture 24% from the get-go. That's huge. I'm up 24%, even if the property doesn't cash flow. Right? When I realized that, I said, there is nothing. I can't get that anywhere else. Right? So, I mean, it's one of the hacks, I guess, in life that when people don't teach you, you just don't know. But once I learned about it and I crunched the numbers, I said, this is ridiculous. I don't even know how this is legal. Right? You know? So now,
and we're certainly glad that it is.
right. And going back to 100%, I see this is exciting news chats on here. I'm thinking that maybe that's what everyone's talking about, right? So, and then Smitty talked about travel costs, partying with Marco is 100% deductible, you know. Getting the slide deck. We're gonna put this video out later on. So, anyone has any questions or anything that they like to kind of open things up?
I do, Alex.
Yeah.
So in my fourplex, right? I bought it in I closed on it January of 2020. So would it still be good or worth it to do a cost segregation, or is that a thing you do as soon as you buy the property? I don't know if if you can speak to
I would talk to a cost segregation specialist about that, because what they'll do is they'll do these evaluations for free. Right? They usually would be like, hey, yeah, show me the property. Because in these cost seg, whether it's Boomer, Giannis, I think that's his name, Jonas, yeah, they do these evaluations like, hey, shoot me the property. Even before you even buy the property, they're like, hey, shoot it over to me, show me the underwriting, let me tell you what you're gonna get, and go from there. I would say they would have no problem doing a free one just for you. And within a few minutes, they'll be like, yeah, is it worth it? Is it not? Here's the numbers, what that potentially looks like.
Awesome.
And then you'll be able to figure out. A lot of times it is still worth it because you're only a few years in.
Yeah. Okay, thank you. Yep. And I paid 15,000 in taxes last year. So yeah, it would be great to reduce that even a little bit, so.
Yeah.
Then it's worth it. If you're still paying taxes, it's worth it.
Awesome. Thanks, Mike.
Yeah. I don't even get into a deal unless if I know they're doing a cost. I was like, you doing a cost seg this year? Deal or no deal? That's 24% on the line right there. Shit.
Same. Like you have to have a cost segregation study done. That's one of the first questions I asked too, Alex. That's absolutely.
Yeah. I mean, even the deals that have been really good, I've gone away from it because they didn't do a cost. Oh, I will do it next year. I was like, I'm looking for this year, brother. I'm not looking for next year. So yeah.
Does anybody else have any questions or any even case studies to bring up since we're all here?
Could I touch on something for the quick claim deed and changing it over to an entity as well?
Sure, absolutely. Go for it.
Make sure that you're looking at it from multiple layers. So I know Cipriano and Smitty were both kind of in the same thing, but there's the one to get it out of your name into the LLC for protection for sure. And then each state is different based on your disclosure. So like, if we were to do that right now, like some of our friends are doing this on a property and they're worried about it because the quick claim deed is no problem. They're not going to get the due on sale clause, but the tax assessor has been looking for anything to revalue and up the taxes, right? So depending on how you do the paperwork in your state, make sure you're trying to fly under the radar if your expense is already down. If there's going to be a big tax jump from the last 5 years when you bought it and then you switch over, that may be an avenue for the tax assessor to get in there and raise your taxes. But the overall benefit of it going into an LLC, I think, is invaluable because it's going to protect you for the long run, right? Like even if it does raise your taxes a little bit, you need to be protected because I think everybody in this room is trying to build like a portfolio, right? And if you don't have it in an LLC, then all of your portfolio is in jeopardy for that one property. But yeah, there's different things. Some other people are worried about insurance going up when they do it, right? If their property gets revalued, some of them taxes, things like that. So from your standpoint on your finances, make sure you're looking at that and kind of try to talk to somebody in your area that knows how to avoid those things, and kind of keep that under the radar on that.
Yeah, thanks. Thank you so much for the share, Michael. That's valuable. I mean, we're all here to protect ourselves and, to help each other protect our real estate investments. That's great. Thank you so much. Teresa, I know you have a question. Please.
Oh,
share.
hey, I was just going to add to what Mike said. You should ask your CPA about rules in the states that you're doing that in, because like in Tennessee, you can't do that. You also can't put it in a trust. You have to do other things. And for I only have one Tennessee property, and this is not for multifamily. This is for small multifamily and single family homes. I put them in land trusts, and then I have a management company that's a state LLC managing them. But the companies and the land trust, the beneficiary is a Wyoming holding company, and that gives me anonymity and protection. So I'm covered that way. That's just something to think about.
Yeah,
Awesome.
thank you so much for the
sharing.
share. That's actually really good, because not only is it protection, but you're right. If you have a layer of anonymity on top of that, that's, I think, even better.
It just depends on what your goal is. I mean, those properties I'm keeping, so I'm keeping them because they cash flow great. But the land trust it's the same kind of document, same way to fill it out as a quitclaim deed, but a quitclaim deed is really easy. I mean, and getting an LLC is very easy too. If you want, I use Northwest Registered Agent, and they'll provide you all the documents and anything else that you want. It's pretty cheap. I mean, if I can do it, anybody can do it. So
Awesome.
that's all I
Thanks,
got.
Lisa.
I just thought I'd let you know. So
Thank you for the share. Any
Thank you.
information is useful. I mean, especially if it's going to help the group here.
Yeah. I'm gonna stop the recording right now here.